Welcome to Frankly Speaking, the podcast on responsible business from Frank Bold, the European public interest law firm. I'm Richard Howitt, and after many years leading responsible business issues and debates in the European Parliament, I lead our discussions about corporate sustainability, sustainable finance, business and human rights. Today, there's a lot being written and said about so-called ESG investment being on the retreat. But what do the leaders, the specialist responsible investors, say themselves? My guests to discuss this are Nathalie Dogniez, Chair of the European Sustainable Investment Forum, Eurosif, and also Independent Director on various fund manager and administrator boards with a particular focus on ESG and sustainable investments. And I'm also joined by Julian Toth, Investment Manager at Responsible Investor Soulmates Ventures and Director at the Czech Sustainable Investment Forum. Welcome to Frankly Speaking, Nathalie.
Thank you, Richard, for inviting me today. It's a great pleasure to be here with you.
And welcome to Julian.
Thank you very much, and thanks for the invitation.
Now, I mentioned all these media reports, and I think they are confusing because they speak in both directions. We get reports of specialist funds closing or being renamed, a slowdown of new funds being launched, and outflows of funds from the investment funds that are left. And on the other hand, you read that there are still net inflows and that responsible investors are staying the course. Nathalie, which is right?
Well, let's put it that way. 10 years ago, sustainable investing was a niche sector, and then it moved to being very hype like 5 years ago. Now what we see is a little bit of a return of the pendulum, and I believe that we're softly landing where sustainable investing should be. An important consideration, a key consideration for investors, medium to long-term investors that wants to hedge their risk, and a conviction statement for those investors that cares about sustainability.
Same question, Julian. How do you see that?
I personally, what I think I see in the market, not only in the region, but also globally, when you mentioned, Richard, that renaming the funds but also seeing the inflows, I think there's some kind of communication/marketing change as well, is what we see, especially over the last 1 or 2 years. And that's, I think, mainly driven also by the geopolitics and maybe political situation and some of the political pressures in, for example, the US, especially the last year. Back then, you do remember there was a lot of discussions about large asset managers, banks leaving alliances and essentially changing some of the communication strategies and how they approach and how they talk about ESG investing. And so that was what we saw in the media. But then when you actually are part of some of the closer discussions, you speak to some of the funds, they didn't really, at least that was my finding, they didn't really change the internal approach, how they assess ESG risk, how they assess climate risk in their investments, right? So this is something I saw also with some funds where I used to work in the past, where to integrate, to actually go through the entire process to incorporate ESG assessment or, for example, responsible investing assessment in their processes. That took many years to make it more sophisticated. And I think essentially to be more adapted to what was happening globally in terms of politics, I think they decided to communicate it differently to maybe ease some of the pressures. But I think when it comes to making decisions and using data to make decisions and to manage risks, I think they continue and they use ESG data still.
Totally agree with you, Julian. It is a fundamental of investment decision, and this trend is not to be forgotten and will be staying forever. So we have moved from something being hype to a fundamental in investment decision and risk management.
And Nathalie, Julian talked there about the investors that have quit, supposedly. So the Net Zero Asset Managers Initiative. Several investors have left that. The Net Zero Banking Alliance has collapsed altogether and is closed. I noticed that State Street left the initiative in the United States, but stayed in it in Europe, which is an interesting decision on their part. Do those investors quitting apparently the race to net zero, does that matter?
Well, it matters in terms of public image and public perception for sure. But you need to put that in the perspective that I was mentioning earlier. I mean, sustainable finance is not anymore a marketing decision. It's a fundamental in the investment decision. Moving from an alliance where some organization may have joined from a public relation perspective, has nothing to say with how they manage the money, how they invest and take into consideration, for instance, transition risk in investment decision. But I guess what is really important for people to understand is that, whatever be the big announcements out there, which may be driven for public image or political perspective, the key is that, transition today is a fundamental, it's essential for the future of European citizen, of European economy. So it's not something that should be marketing driven. It's not marketing material. It's about a real risk, and any delays we would be taking into the transition is exposing us to, I would say, financial risk. And if we're slowing down in the transition, we're cutting significantly any, I would say, return prospect for European industry in the future.
If I'm not mistaken, I think most of the essentially departure from some of the alliances actually originated in the US, which I think went hand in hand with what I was saying as well, because I don't want to only blame, let's say, communication marketing and essentially how the funds asset managers position themselves in terms of communication, but I think it's more complicated, a more complex issue. But having said that, I think it was also about certain signals, right? It's about how are you perceived in the capital markets and essentially in the sustainable investing market in a political situation where there's a lot of pressure against some of these topics or domains, and being part of multiple alliances and institutions and so on, organizations which are mainly and solely focused on pushing the agenda. I think it was not perceived as strategic at that point, which I think that is the main issue. And that's exactly to Nathalie's point about the public appearance, public signal, so to speak. Because I mean, what is crucial is that some of these large companies, they actually go and they push the agenda, and they make it very clear that whether that's ESG, sustainability, climate, it's not just some kind of ideology or some kind of marketing, but it's actually core of their risk management and investment approach, especially long term. So I think that's why it was a little bit disappointing from certain perspective as well, that they gave in and they actually left some of the alliances. But as I said, I think it was a bit more complicated because I currently don't really know exactly what were the conditions, some of the commitments and so on. I still feel like even after leaving many alliances, I feel that especially the largest asset managers continue mainly internally doing the same things when it comes to risk management.
Totally agree. And I guess we have to put this decision in a broadly, I would say, global political context, which is very complex, very challenging, but also still very different in the US compared to Europe. And as I was mentioning, we talk about a lot today about European sovereignty, about European defense, but what is fundamental is to understand that the transition out of fossil fuel towards I would say clean energy is a key factor of European independence and sovereignty. And so we shouldn't be bogged down into political decision taken out of the US to influence the political agenda, but also the investment made in Europe.
You talked there about defence, Nathalie, and there's a debate going on within the responsible investment sector about whether all of the new defence expenditure, which is being planned by European companies, can ever be responsible. In the old days, any arms were just automatically screened out, and that was that. But there's now some real serious work on trying to get guidance for responsible investment in defence, and I know Eurosif brought out a recent paper on that. Can it ever be responsible?
Well, it's a very good, complex, and sensitive questions you're raising here, Richard. So in fact, we have published I would say, discussion paper that maps out the complexity of this question. First, I think it's really important to distinguish the government investment, the public money that should be invested or spent out to protect European citizens versus, I would say, private investment for normal investors or sustainable investors. Then I would say it's important also to remind that, the sustainable finance framework, the European framework, is, I would say, sectorial neutral and is neutral towards defense. Then it's up and to each manager to, I would say, to implement their own, I would say, screening process based on what are their sustainability objective and what are the sustainability expectation of the investors. And I would say there is a common consensus about exclusion of cluster munition, for instance. But then there is much more nuances depending, on the type of investments we are talking about. Screening criteria may be different from one portfolio to the other. So there is not a strict exclusion of defense investment in a sustainable portfolio. If I may summarize, I would say in one sentence, a very complex matter. And if you want to have more details and nuances, I would advise you to consult our discussion paper.
And of course, those emerging guidelines for responsible investment in defence grid, all available on the internet. Julian, you're now working in venture capital, and the CIF in Czechia recently produced a report showing that private equity and venture capital was integrating ESG, moving along the spectrum in terms of responsibility and investment. Tell me what you found in that study.
I thought you were going to ask me about the defense as well, so this is much nicer. No. We did indeed do a report, and maybe a little bit of context as well, because so now under Czech SIF, so I mean, hopefully, and I do believe that all the listeners understand the objective and the purpose of SIFs. In fact, so Czech SIF is a member of Eurosif as well, and we all share certain objective where we try to accelerate sustainable investing in Europe, in Czechia, and I think in Central Eastern Europe it is. I mean, I don't really want to say it's different. I think some of the discussions maybe are at different level, but I think it's developing a lot. But there was still a lot to do when we started 3-4 years ago, especially in terms of maybe explaining some of the concepts and how to integrate it in practice, and maybe how to actually leverage, whether that's ESG, but maybe sustainability for value creation as a strategic tool. And I think that's as opposed to seeing this as some kind of compliance burden. And the way how we decided to do that was through case studies. And in fact, that was actually very much demanded by the members, where every time when we had a discussion about, so what do you need? What exactly maybe can we do as Czech SIF, in terms of the community and building this discussion, it was, well, we need some examples. And the reason for examples is quite simple, I think, and it is mainly because many of not only application of some of the regulation, but also actually tackling and grasping some of the concepts in practice, it's not that simple sometimes, right? Especially when you started a few years ago, there's a lot of changing and moving parts. So we did a couple of case studies in this paper looking at how some of the local funds actually hands-on use sustainability or ESG for value creation, so actually for alpha. And yeah, there are some interesting examples for how some funds used it also for fundraising, especially from large institutional investors, right? Who want more commitments or maybe more precise understanding how KPIs have been set for sustainability and so on. But also we discussed the first corporate green bonds, a green bond in the region. And also there's a couple of Article 8 or Article 9 funds. So I think there's interesting things happening. You can definitely look at the publication. For us, as working in this VC, you mentioned Soulmates Ventures, we actually are one of very few Article 9 funds in the region, and one of very few Article 9 VC funds. which makes it more difficult because we invest in startups, right? So to ask for ESG data from startups, that can be a challenge on its own.
But you do it.
Yeah.
Now, Nathalie, we've got through 2/3 of this podcast without mentioning the Omnibus or ESRS or the Sustainable Finance Disclosure Regulation, but our podcast does track what's happening at the European level, and Eurosif is a major stakeholder in those discussions. First on SFDR, the rules, disclosure rules for investors themselves. You've welcomed the proposed new badges or names for different funds, but you've said perhaps not robust enough. Just tell us what your concerns are in relation to that.
You mean the proposal on SFDR 2.0? Well, we welcome the fact that we're moving from pure disclosure to a real, I would say, classification of product with supporting underlying criteria. What is great is that we will have now 3 categories: sustainable investment, transition, and then ESG basic category. And so we really, really welcome having a transition category, because transition is absolutely key, as I was saying, for the development of the global and the European economy. So a transition category is something fundamental. Now, what is key, and that will be developed together with the level 2 of SFDR 2.0, is to have clear criteria underpinning each of the 3 categories. And this is where I would say we have made some recommendation in our responses to the current proposals, and we are keen on following up the level 2 measure to have clear criteria underpinning the product classification, and clear criteria that will also be, I would say, appropriate for all categories of investment, not just listed investment, but also private and real assets.
And some people do say that the new ESG basics tag might become the old Article 8 and a bit of a catch-all, and still subject to the accusation of greenwashing. Can I ask you as well, Nathalie, about the Omnibus, and in particular, the concern that Eurosif has had throughout, that you're losing information that investors need. And in the latest version of ESRS that are proposed by the European Commission and out for consultation now, asset managers themselves are fully excluded. How far are you concerned about those things?
Well, basically, for us, Omnibus 1 was a significant step back, because let's face it, as Julian said, ESG data, sustainability data is absolutely key today when you do take an investment decision or when you're managing the risk at portfolio level. And today, investment managers are largely relying on estimated data provided by data vendors. We were hoping that CSRD would be solving the problem by imposing a standardized set of data being reported by companies that you could be relying upon and comparing companies to company. With Omnibus 1, I would say this dream has faded away, because now 90% of the companies are suddenly out scope of this regulation. In parallel, there was also an exercise to simplify the ISRS. I would say that we welcome this simplification, but we've come up to a level which is the bare minimum in terms of data cutting. And basically, the draft as it stands for the time being is the absolute minimum to produce the information that investors need. We are also concerned about some proposal to remove the anticipated financial effect of sustainability risk on companies. Again, this is a very fundamental and key information for investor to manage and assess the risk at the investment and at portfolio level. It's absolutely key to keep this information in the ISRS. and we might be concerned about some of the potential relief that you have in the current draft of the ICRS simplification.
We'll see what the European Commission concludes after its consultation. Julian, really on the same point, but there's a debate going on in America that it doesn't matter that the regulation is rolled back because investors are going to ask for this information anyway. They're going to do more and more engagement on sustainability issues, and that will fill the gap. And there's a debate going on in Europe that the attempts to have a value chain cap and to limit what information can be asked for is going to severely limit the information the investors need. Where do you come down between those two?
So this is a tough question. So I'll try to juggle it. What you mentioned, the asset managers being excluded from ESRS, and I'll go from here and try to link it to the US. So on the one hand, I understand the reasoning behind it, and I think it actually makes sense in terms of avoiding double counting and the logic in terms of fiduciary duty and asset managers not necessarily directly reaping the economic benefits and risks from the allocation. But at the same time, it does, if they're not included and they will not have to report on finance emissions under Scope 3, then it removes certain pressure, right, for some of the SMEs. And now to your point, so you're saying that the discussion goes that it's regardless the simplification and Omnibus, the investors will still ask for the data. Yes, on the one hand, but that's the difficult core of the discussion is obviously what we need as input for investment and more informed investment data-based decisions, and how much of a burden we want to put on smaller companies, especially. And I think where we are heading now, it's maybe a bit more sophistication in terms of how the Commission is approaching that, because I think the original ESG and ESRS was a bit more sort of scale, bit broader, not necessarily maybe considering all these nuances with how much of a burden this can be for small companies. Now we see with, for example, VSMEs, so voluntary standards, as well as the cap. I feel like that hopefully, let's see, might hit slightly better balance, because I think the investment funds, financial institutions, I think they will ask for the data, but at the same time, I do feel like now through VSME, the smaller companies, SME might be a bit more guarded and might have much more clarity about what data they can and they should provide. Hopefully, there will be less different questionnaires coming from different sides, and there's more standardization for them as well. I think it's a strong signal from the Commission showing that, okay, SMEs, we understand you have different pressures, and there's a lot of other things, and you don't have capacity to deal with all of this. So here you go, take this. And I think that creates a bit more balance in what, for example, the financial institutions can and should ask. So it could be too early to say, but I do hope this will bring slightly more ease. At the same time, having said that, because to what Natalie said, because there will be obviously some kind of data gap, then we are, and I think this is already discussed at ESMA, I think this is one of the main points, we are already expecting slightly different data reality, right? Where there will be more estimates, there will be more ratings. And I think that's why we are working through, and we have the ESG rating regulation as well, to maybe get more transparency and understanding how some of the ratings are created, so we can rely on it a little bit more, and that can create or maybe fill the data gaps. So I feel like we are now fine-tuning what needs to happen to actually get the data on different fronts, but currently maybe too early to say what will be the outcome and how well it's going to work.
I've got a last question for both of you. Julian first. You're a Sherpa for the European Sustainable Finance Platform. And of course, Europe now for some years has had its sustainable finance strategy, really trying to transition Europe's own finances towards a sustainable financial system. Some people say the Green Deal is just being ripped up and all of the gains the last 5 years are lost. Is that your view, or what do you see in this 5 years of the European Commission and the European institutions? What do you see as still potentially being progress in terms of European sustainable finance?
Yeah, that's a really nice question, because actually like to keep it optimistic. Maybe just a quick caveat. So I used to be a Sherpa, but then since I left the International Sustainable Finance Center, my colleague replaced me. But
Okay.
as Linda Zeilina, the CEO, she still remained on the platform. But I was indeed very much integrated also in the platform, also sustainability committee at ESMA, but based in Prague. So I think gave me this interesting view being in Central Europe, but also participating in discussions in Brussels. I I must say, this is frankly speaking, on a personal note, I actually reflected on this recently because I moved after 6 years from my previous role.
Mm.
And sometimes, especially in the region, and I don't want to be too skeptical, but sometimes the discussions may be a little bit more difficult, or maybe less strategic and less proactive in the region. I am actually quite optimistic, and I think a lot has been done. I remember some of the first discussion about the EU taxonomy back in 2018. I On the one hand, I do see some of the major complexities with the regulation and interoperability between them and how difficult it might be to tackle, not only for small companies or large. But I think in terms of how much we have progressed on, hopefully, at least that's my view, seeing sustainability as an actual resilience and sort of strategic tool and being more prepared for the future, especially long term. And now having more and more tools at your disposal to use it and different guidance. And maybe I think we moved from companies, financial institutions, especially now, even in the region, and we're not there yet 100%, but definitely we have moved from, okay, there is something, some kind of compliance, there is some kind of regulation. We actually moved to, all right, so we actually need to use the data smartly. We need to use it to make decisions. We need to be more adapted to how the economy is changing. And ideally, and we see that in Czechia, we see that in Poland, ideally also participate in it and leverage it as an opportunity, right? To actually make money on this. And I don't think this is the case in like 80% of the companies, but it's definitely much better than 2 years ago or 4 years ago, and maybe even last year. And I think Omnibus, if nothing else, to maybe your previous question, it definitely did maybe, I think it potentially slowed some things down with especially some of the momentum on reporting and so on. But I think at the same time, especially some countries in the region, I think they welcome it from the perspective of, okay, let's simplify, let's focus on the right things, but let's still identify the right data we need to use, how to use it, and then so we can maybe progress faster. So I don't see that the EU Green Deal is dead or that it's not happening anymore. I think it was good to take the stock, maybe take a second and actually like look at it, how we can make things more efficient and more practical. Because at a certain point, I think that pragmatism, especially from the region, was something that created a conflict sometimes when it comes to integration and seeing this as compliance. And I feel like now we have slightly cleaner slate to use it and see it more strategically. So I'm still a bit quite optimistic on that front.
Nathalie, can I ask you an even broader question? Europe is seen as a leader, and so what we've been talking about is absolutely crucial to all this. But on the podcast, when we discuss sustainable finance, I go back to the United Nations Environment Programme Finance Initiative at UN, UNEP FI, who 10 or more years ago now set this objective of the entire world financial system becoming a sustainable financial system. Is that dream still alive? And how far are we along the way to getting there?
Well, Richard, I've been having this dream for the last 25 years. So, if I take I would say a longer perspective, yes, we had a little bit of political, I would say, step back over the last 2 years. But if we take a longer perspective, we are far more advanced than where we were 5 or 6 years ago when everybody started to talk about sustainable finance, but there was less, I would say, less skill set, less understanding of what it meant really, amongst the players on the market, but also amongst the regulator, amongst the standard setter. Now, as Julian has explained, it has really been part of how do we invest? How do we take, medium to longer term perspective into consideration? How do we take risk into consideration? So even though we had some step back over the past months, I believe that, we are far more advanced towards that goal of, sustainability being fully integrated in the financial sector investment decision than where we were 5-10 years ago. And I believe we are still, I would say, progressing towards I would say the objective. At least in Europe, we are still progressing a little bit slower than what I would have been hoping. But, I'm optimistic and I see the progress and I see that, we will get there at some point in time because increasingly investors and citizens, understand the importance of the transition.
Very quick point on that. And it's exactly the word Nathalie ended on. Its transition is actually quite, I think, hopeful as well, because especially in the CE region where the energy mix is still fossil fuel based in some countries, we do have a very big heavy industry as well and more emitting industries here. I think the transition actually opens even more practical discussion where we go from just reporting data, but actually looking at some kind of like credible transition plan, decarbonization plan, meaning roadmap, right? This is I think that's a crucial difference here compared to 3 years ago. If nothing else, and I know we are still early in the transition discussion. I know we now, even at ESMA, this is one of the main points. We are looking at the credible transition plans. We see the SFDR new category, but I think this is much bigger step than we think or maybe appreciate, because this changes the discussion how financial institutions talk to the portfolio companies. And it's not only about, well, send us this report so we have some kind of historical data or from last year and we have, well, we can see your energy use, But actually having a discussion about, okay, so what is your destination? How do you want to get there? What is the plan together? And then we can look at how to finance it. We can look at some of the potential challenges and so on. So I think the lens changed. And I think this is crucial and actually really important to have it in SFDR, right? Because it opens a discussion about more forward-looking approach.
In this podcast, we've heard that there has been a pushback on responsible investment, but Nathalie talked about a soft landing, and both of our guests talked about no fundamental change of approach in terms of how investors are actually making their investment decisions. Although Nathalie did say that the public perception does matter in terms of what companies say. That dreaded word green hushing hasn't been said till now, but it's definitely out there. We've heard about the potential investment in defence being responsible or not responsible. It's a complicated matter that Eurosif have looked at the nuances of, so do look at their paper if you're interested in that. But there are still some fixed points. For example, cluster munitions are definitely excluded. We heard from Julian about how investors and the markets wanted case studies to show how responsible investment is working, and that it's not a burden, and that has been really effective in Czechia and within the region. We discussed the European legislative developments on SFDR, Sustainable Finance Disclosure Regulation. Nathalie asked for very clear and more robust criteria in level 2. And in terms of the Omnibus, she talked about the dream of having common data having faded away, and that the data points now included in European Sustainability Reporting Standards, ESRS, being the, quote, bare minimum. But both of our speakers talked positively at the end. Julian talked about responsible investment now being seen as a strategic tool, that it is about the resilience of the company, about how far the company is future fit, and it is, in his words, about alpha producing returns. And Nathalie talked about the fact that the responsible investment sector is much advanced even than 2 years ago. Both of our speakers talked about a slowdown, but not a reverse. The concept of transition and the credibility of company transition plans are going to be a really future watermark for what responsible investors are doing. It's been a really fascinating discussion. And to Nathalie Dogniez and to Julian Toth, thank you so much for joining us.
Thank you for inviting us, Richard. It was a real pleasure as well.
Thank you very much. Same here. Thanks.
You've been listening to Frankly Speaking, the Frank Bold podcast on responsible business. Find out more about Frank Bold's Responsible Companies section on our website, and please give us your feedback on our LinkedIn page or by commenting via your podcast provider, where we hope you will share the conversation and give this podcast a 5-star rating. And remember, you can watch us now on our YouTube channel too. Thank you again to Julian, to Nathalie, and to all of you for listening. Do join us next time, and goodbye.